Hi, my name's Tracy Smith. I'm a first-year MHA student presenting on DuPont analysis for HPML 523 Healthcare Finance. What is the DuPont analysis? The DuPont analysis was actually named after the company that developed it. Fun, interesting fact, I live a mile from one of the DuPont plants currently. If you're familiar with the movie Dark Waters, it was based on the plant that I live near. If you haven't seen that, definitely an interesting movie to watch. But basically, the DuPont analysis is an analysis that decomposes return on equity, and return on equity is the measure of dollar of earnings per dollar of equity investment. And there's three components to this analysis: the profit margin, which is the expense control, the total asset turnover, which is asset utilization, and the equity multiplier, which is your debt utilization. So the DuPont equation is listed out here. Your return on equity is your total margin times your total asset turnover times your equity multiplier. And it's broke down here on the lower portion. So you'll see that the net income divided by the total equity is on the left side of the equal sign. When you look at the equation broke out, total revenues and total assets are both in the numerator and the denominator, so they're essentially canceling themselves out. And that's how you get net income over total equity. Here you'll see the Bobcat hospitals, where we are going to look at the DuPont analysis for that hospital, their financials, both their statement of operations and their balance sheet. I would like to point out, or you should note, that in the 2020 statement of operations, the operating income is red and $2. It's also noted in parentheses. So when you see that on a financial sheet, that does indicate that it is a negative balance. So this is the DuPont analysis for Bobcat Hospital, and I've long form done the calculation according to the long form equation that's listed at the top for both 2019 and 2020. And all of the numbers that you see here were taken from either the statement of operations or the balance sheet. So the values that were listed there, you'll notice that this equation is evaluating their financial condition by calculating the return on equity. In 2019, that value was 6.4%, and you'll notice that in 2020 is a negative 0.04%. And that really is brought on by the negative value of on the 2020 statement, where they had a net loss that resulted in a negative return on equity. So when you're looking at these numbers, they really just look like numbers. Obviously, we can see from 2019 to 2020 that the numbers are changing and going to a negative side for the next year. But really, in order to do a value analysis of the numbers that you're seeing, you need to benchmark that against either other organizations, against yourself year to year, against your peers if you're part of a hospital system, your competition, or there's also opportunities to look at any one of these financial analysis against what is essentially the national benchmark. So that could be in the top 25%. It can be in the low 25%, but that will give some relevance to the values for any of your financial analysis. Benchmarking, like I said, is where you're going to put yourself up against other organizations. So this is just a few examples of some financial analysis equations that we've learned about this week in our lectures. You'll see that we have the values for Bobcat in 2019 and 2020, and then from Optimum or HPML to benchmark against. And these benchmarks were also included in the Excel file that was provided for this project. So just a couple of the examples, the current ratio. So the current ratio is current assets divided by current liabilities. And what you're getting from that is what your immediate liquidation of your current assets at book value would be for every dollar of liability. So essentially, for example, if you're looking at Bobcat's 2020 current ratio at 2.1, what that's telling you is that you would have $2.10 of cash for every $1 of liability. The next one is the total margin. which is net income divided by total revenues. And that's really measuring your ability to generate revenue and control expenses. Obviously, the higher total margin, the lower expenses relative to the revenue. So the debt ratio is the total debt divided by the total asset. Creditors really prefer a low debt ratio because it's going to make it more favorable if you want to borrow money. You can also look at the debt ratio as an equity ratio by taking 1 and subtracting whatever the debt ratio is. The operating margin is the operating income divided by the net operating revenues, and that's really where you're focusing on your core, business activities. And your average age of plant in years, this is really evaluating your facility that your business is located in, and that's calculated because of accumulated depression divided by depression expense. And you obviously want a lower number here. You can see that the benchmark is 11.8. And where this can impact you is, as your facility ages, then your average age of plant is going to start rolling into capital expenses. I do want to point out too, when you're looking at these values, you'll notice that the total margin and the operating margin, the values are the same for both values, and that's because the total margin is going to have you calculate the net income. And in the example provided to us, net income, as you know, is operating income plus non-operating income. In this example, they did not have any non-operating income, so essentially the value was the same for both equations. And if you look at this, you can really see where Bobcat Hospital is stacking up against the benchmark for some comparisons. So suggestions that I would have to improve the financial situation for Bobcat Hospital, obviously they need to increase their revenue and reduce their expenses. If you're looking at the values from the slide with the balance sheet and the statement of operations, there weren't a lot of changes in any of the metrics year to year, but the salary, wages, and benefits did increase from 2019 to 2020, which, obviously that can be expected with inflation and, annual pay raises that you give your staff. But I've certainly worked in organizations where we didn't have the money to give raises, which is very difficult on your frontline team, but sometimes it's just something you're not able to provide. Or they may want to consider, evaluating any overtime usage or flexing their staff when their volumes are low. Those are some options that could help to reduce that salary, wages, and benefits line item. The other thing, too, is they could look at their revenues, which essentially were unchanged from 2019 to 2020. So they might want to take a look at their charge master and see if there's opportunities to increase their prices to help increase their revenues. They also should probably take a look at their contracts with their payers to see if there's any other opportunities to negotiate terms of anything that might need to be increased. And then you always, in any kind of business, should look for opportunities to eliminate waste. So working with your frontline staff to let them understand that you do need to reduce your expenses through your supply use is always going to be beneficial. Closing remarks. Obviously, I know a lot of people in this program are either very young and just starting out in their careers, or I've been in leadership a while. I can tell you that understanding finance has been one of the biggest difficult struggles for me to learn. Getting into this class, I thought I was trending towards knowing more about finance, but there's still a lot for me to understand. I went from managing a department with a very small budget, and now I have 8 cost centers with multi-million dollars in budgeting. So I do meet with my financing team regularly. A lot of that's my own choice. Interestingly enough, I reached out to my CFO just to ask him what he focuses on with the analysis. He said days in account receivable, days cash on hand, FTEs, per adjusted patient day. Those are the ones he really focuses on, and of course his operating margin. So really just understanding your role and how you can make a difference is really vital when you're learning about finance. And these are my references. So thank you.